There is no doubt about who the king of dividend investing is. In 2021, Warren Buffett collected close to $4 billion in dividend income, and over the next 12 months, Buffett's holdings are expected to generate over $6 billion in dividend income. Warren Buffett's entire life is a clear example of how the power of long-term dividend investing creates a compounding effect that makes it ridiculously easy to generate wealth. He gives a great demonstration of the compounding effect in this interview.
Let me give you a figure that'll blow your mind, I think. I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. Three shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today.
Oh man!
Well, it's
okay.
You know, but I just want your audience to think for a second.
Okay.
The answer is about $400,000. So if I, as a little kid, had taken that $114 I'd saved shoveling snow or whatever I'd done, $400,000 today, one person's lifetime. That's America. I mean, that isn't me. You know, it is the huge tailwind the American economy gives to any equity investor. Now, the market's gone down many times during that time. People have panicked during that time. Headlines have been terrible. You know, it looked like we were losing the war when we first bought it. But America is a powerful economic machine that since 1776 has worked, and it's going to keep working. Now, you don't want to buy to hold for a year. You don't want to buy with the idea that you could sell it in 2 years or 3 years, necessarily make money. You could lose money that way. But if you buy it for 10, 20, just keep buying the S&P 500 index and forget about all the other nonsense that's being sold to you, because I'll guarantee you one thing about the stuff being sold to you: it will carry bigger fees than what I'm talking about.
Yes.
Yeah.
So what investments did Warren Buffett make to create this compounding effect? In this video, we're going to be analyzing the top 3 largest holdings in Warren Buffett's portfolio. If you'd like to download the spreadsheet used to analyze these stocks, then you can head over to my Patreon page at the link in the description. The first and largest holding in Warren Buffett's portfolio is Apple, stock ticker AAPL. This is a company that takes up over 40% of his entire portfolio. We can see they're currently trading at a price of $139.50 per share. And like we mentioned earlier, he obviously loves to focus on dividend growth. And Apple just started paying a dividend around 10 years ago. And if we scroll down, we can see since then they have over doubled the amount they pay out in dividends. But let's go ahead and jump into our stock valuation spreadsheet to see if we can calculate its intrinsic value. So we'll come up here and plug in the stock ticker and hit enter, and you can see all of this data will automatically load in. The current dividend yield for this company is sitting at 0.66%, and they're paying out 92 cents per share in dividends with a payout ratio of just 14.6%, meaning they have plenty of room to continue to grow their dividend payments over time. Now, analysts currently have a target price of $179 per share, and the beta for this company is sitting at 1.24, so you will see a little bit more volatility than normal. But let's go ahead and jump into our first valuation, which is going to be Graham's valuation. And this is actually a valuation model invented by Benjamin Graham, who is one of Warren Buffett's mentors. And here's the formula he lays out for us to calculate intrinsic value. So the first thing we need is our earnings per share, which we have automatically pulled right here. We then apply our growth rate projection, and analysts still have pretty positive views for Apple when it comes to the growth rate projection. We're projecting a growth rate of 13, and then we want to apply the current yield of AAA corporate bonds for Y right here. And at the time of this video, it's sitting at 5.2, which is quite a bit higher than it has been over the past year. But when we plug all these in, you can see we come to an intrinsic value of $103 per share, quite a bit below that current trading price. Now keep in mind, earlier this year, the current yield on AAA corporate bonds was as low as 2.8. So if it were to go back to that number, we come to an intrinsic value much higher than that. So keep in mind, the current market conditions are really driving this valuation method down. Now, the next valuation method we'll look at is the discounted cash flow model. And in order to perform a discounted cash flow analysis, we need to project a growth rate to the future free cash flows for the company. So to do this, you can see I plugged in the historical free cash flow for Apple so we can see our year-over-year growth rates. And over the past few years, they've had an average growth rate of around 12.75%. And I'm applying a growth rate of 13% based off of that to the future free cash flows. Once we've done that, we calculate the terminal value, which is the sum of all the future free cash flows past the year 2030. We then take the present value of those future free cash flows and add them together here, add Apple's cash and cash equivalents, and subtract out their total debt to find their equity value. Once we've done that, we divide by the number of shares outstanding, and we come to a discounted cash flow price per share of $190, quite a bit higher than that current trading price. The next valuation we will look at is our multiples valuation. And the idea behind this valuation model is we should be able to value a company based on how the market is valuing companies that are similar in structure. So we're taking companies like Microsoft, Google, and Meta. We're taking their stock price, dividing by the earnings per share to get their price to earnings multiple. We then take the average price to earnings multiple of these companies and multiply it by Apple's earnings per share. And that gives us an intrinsic value of around $139 per share. Now keep in mind, we're in the middle of a huge market decline, so all of the price to earnings multiples are going to be slightly lower during this time, which may mean that the multiples valuation could likely lead to a higher valuation under normal market conditions. Now moving forward, we're actually not going to look at the dividend discount model because Apple still provides most of its value in the form of free cash flow growth. While they do pay a growing dividend, I think they haven't quite focused as much on this dividend, as you can see by their payout ratio, as they will in the near future. So when we jump over to our output tab, we can see three different valuation models. The multiples at 139, grams at 103, and discounted cash flow at 190. When we average these three together, we come to an intrinsic value of $144 per share. Now the current trading price is around $139 per share, so when we apply a 10% margin of safety, we can see our acceptable buy price based off of our valuations is around $130 per share. So I think one of the reasons that Warren Buffett really likes this company is because he knows it has so much potential to be such a great dividend growth stock for a very long time. Like I mentioned earlier, they have a slow starting dividend yield, but that payout ratio is currently just sitting at 14.6%, and they have very good free cash flow growth, meaning they're going to be able to grow their dividend for a very long time at a very high rate. So there's no doubt that's one of the reasons Warren Buffett loves this company. Let's go ahead and move on to our next company. The second largest holding in Warren Buffett's portfolio is Bank of America, stock ticker BAC, currently trading at $37.11 per share. This company takes up over 10.5% of Warren Buffett's entire portfolio. And we can see over the past year, they're down about 21.6%, and year to date, they are down 19.64%. So let's go ahead and jump into our stock valuation spreadsheet so we can calculate its intrinsic value. So again, we're going to come up here and we're going to plug in the stock ticker for Bank of America and hit enter. And we can see all of this data is going to automatically load in. If we come over here, we can see the current dividend yield for this company is sitting at 2.37%, and the payout ratio, again, nice and safe at 26.8%. Now, analysts currently have a target price for this company of $41.10. Institutional ownership is pretty good at around 70%, and the beta is sitting at 1.38, so you might see a little bit of volatility. Now, the first valuation that we will look at is Graham's valuation, and again, we have the formula laid out for us right here, and there's three main drivers, just like I mentioned last time. That's going to be our earnings per share, the growth rate projection, and the current yield on AAA corporate bonds. And we can see Bank of America has very solid earnings per share, a decent growth rate projection, but again, that current yield on AAA corporate bond is going to drive down this valuation method. But despite all this, we can see this still leads to a very high intrinsic value of $92 per share. Now, typically the next valuation that we look at is the discounted cash flow analysis model, but that's not always the best way to value a financial stock. But typically there's two other things that I want to look at. And the first one that I want to look at is going to be growing assets under management. That's very important for financial stocks. And as we can see right here, Bank of America is one of the largest banks in the entire country. We can see they've had growing assets under management for about the past 10 years. It's really spiked up over the past few years, as we can see here. And the next thing that we want to look at is the historical price to book value. So let's go ahead and jump over here and we can see the historical price to book value here. One of the things that Warren Buffett has said before is that we as investors want to pay less per share than the book value per share. So essentially we want to see the price to book value at around 1 or below. And price to book value is essentially the market price divided by your assets minus liability. So if you see right here with the current trading price, they have a price to book value of around 1.1. So it's getting very close to that price to book ratio where this does become an attractive investment. But let's go ahead and jump back over to our spreadsheet and look at our last two valuations. And the first one we'll look at is the multiple. So we have some good comparables for Bank of America. We're taking their price to earnings multiple, and on average, their price to earnings multiple is sitting at around 14.42. And if we jump over to our stock screener for Bank of America, we can see their price to earnings is sitting at about 11.74. So when we jump over to our multiples valuation, that it's going to tell us that essentially this is a potential company that is undervalued, leading us to an intrinsic value of around $45.59. Now, the last valuation model, again, the dividend discount model, values a company based on how much they pay out in dividends and how much that dividend is increasing over time. So you can see here, I plugged in the quarterly dividend payouts for the past few years so we can see how much they pay out each year, and we can see our year-over-year dividend growth. So it looks like they had a really good year here of 20%. They did have a year around 2020 where they didn't grow their dividend at all, which is not a good sign. Then they had another huge increase at 16.67%, and their most recent dividend increase around 4.76%. When you take all of these, it still gives them an average growth rate of about 10.3%. So moving forward, I'm applying a growth rate of 6.5%, a discount rate of 9%, which leads to a dividend discount model price per share of around $37.49, pretty close to that current trading price for the company. So let's go ahead and jump over to our output tab. And on the output tab, we're going to be able to see the three valuation models that we used. We have Graham's valuation at $92 per share, the multiples at $45 per share, and the dividend discount model at $37 per share. So when we average all three of these together, we come to an intrinsic value of around $58.63. Now keep in mind, we also liked what we saw with the growing assets under management, and the price to book ratio is getting close to where we want to see it as well. So when we apply a margin of safety of around 20%, we can see based upon this, our acceptable buy price for this company is around $46.90. So this is giving us a signal to buy this stock. So this may be a stock that you want to look into in the future. And the third largest holding in Warren Buffett's portfolio is Coca-Cola, stock ticker KO, currently trading at $59.60 per share. This is a company that takes up about 8.4% of Warren Buffett's portfolio. We can see over the past year, this is one of the few stocks that is actually in the green. They're up 5.81%, and year to date, they're up 0.51%. Now let's go ahead and jump into our stock valuation spreadsheet. And we'll come over here and plug in the stock ticker for Coca-Cola KO and hit enter. You can see all this data will load in. If we come over here, we can see they're paying $1.76 per share in dividends, which gives them a dividend yield of very close to 3%. Now, the payout ratio for this company is quite a bit higher than the past two companies that we've looked at, but this is a much more mature company than those other two companies, so it's not really a red flag. I think they have a very sustainable dividend. Analysts currently have a target price of $66.61 per share, and the beta for this company is sitting at 0.57, so you shouldn't see a whole lot of volatility. Now, the first valuation that we're going to look at is the discounted cash flow model for this company. So if we come over here and zoom in, we can see the projections for this company. I've plugged in the historical free cash flow. We can see over the past few years, they've had an average growth rate of around 6%. Now moving forward, I'm applying a growth rate of around 8% to the future free cash flows and to the terminal value. Once we take the present value of those future free cash flows, we add them together, add Coca-Cola's cash, and subtract out their total debt to find their equity value. And once we divide by the shares outstanding, we come to a discounted cash flow price per share of around $62.10 per share. Now moving forward, we're going to be looking at the multiples valuation. We don't have a whole lot of great comparables for this company, but we do have a couple. So you can see we're taking Pepsi and Monster. We're getting their price to earnings multiple and taking the average, which is around 34.29. Once we multiply that by Coca-Cola's earnings per share, we get an intrinsic value of about $78 per share. Now moving forward, we're going to look at the last valuation, the dividend discount model, and I think this is one of the most important for a company such as Coca-Cola, but we plugged in the quarterly dividend payout so we can see how much they pay out each year. This allows us to see our year-over-year growth rate. For Coca-Cola, it is going to be slightly lower due to the fact they've been increasing the amount they pay in dividends for almost 60 years now. We have a growth rate of 2.5, 2.5, 2.4, and then a pretty good year here at 4.76. So that's an average growth rate over those years of 3.07. So moving forward, I'm projecting a growth rate of around 3.5 and a discount rate of 8%, which gives us a dividend discount model of $40.48 per share. So when we jump over to our output tab, we can see our three valuations: DCF at 62, multiples at 78, and dividend discount model at $40.48 per share. And we average those together, we come to an intrinsic value of $60.26, which is extremely close to the current trading price for this company. So let's say we want to apply a 10% margin of safety based upon this. The acceptable buy price for this company is $54.23 per share. Now, one of the things you do have to keep in mind about this company is this is a company that's typically going to trade at a premium because investors are going to flock to these types of investments during periods of market downturns. They also know this is a very popular dividend safe stock, so people know they're going to get a reliable dividend and a growing dividend when they invest in this stock. But there you go. Those are the 3 largest holdings in Warren Buffett's portfolio. Go ahead and let me know what you think of these companies in the comments down below. And if you own any, go ahead and let me know that as well. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.